The year is 2026, and the investment landscape has never been more unforgiving. Central banks are navigating a tightrope between residual inflation and slowing growth. Geopolitical fractures are reshaping global supply chains. Artificial intelligence is simultaneously creating trillion-dollar opportunities and rendering entire business models obsolete overnight. And the average investor, even the sophisticated one, is paralyzed by the noise. Here is the uncomfortable truth that most financial content will never tell you. Volatility is not your enemy. Complexity is not your enemy. Your real enemy is a portfolio built on assumptions that no longer hold. And in 2026, the cost of operating on outdated assumptions is not a minor underperformance, it is permanent capital destruction. This video is not about chasing returns. It is not about the next hot sector or the asset class that dominated last quarter. This is a systematic, institutional-grade framework for building a portfolio that is genuinely resilient, one that protects your capital in downturns, participates in growth cycles, and compounds wealth across decades, regardless of what the macro environment decides to do next. Let us begin with the foundational principle that separates serious investors from everyone else. A bulletproof portfolio is not built on predictions, it is built on preparation. Every financial commentator you encounter has a forecast. Rates will rise, rates will fall, the dollar will strengthen, equities will correct. And statistically, roughly half of them will be right, purely by chance. The investors who consistently build and preserve wealth are not the ones who predict correctly. They are the ones who structure their holdings so that the outcome is acceptable across multiple scenarios. This is not pessimism. This is engineering. The first pillar of a bulletproof portfolio is strategic asset allocation, anchored in real diversification. And let us be precise about what real diversification means, because most people are doing a version of it that is deeply flawed. Holding 30 stocks across different sectors inside a single country in a single currency, correlated to a single economic cycle, is not diversification. It is concentration wearing a disguise. True diversification in 2026 requires exposure across asset classes that behave differently under different macroeconomic regimes. That means domestic and international equities, but with intentional geographic and currency distribution. It means fixed income structured as not a growth vehicle, but as a volatility dampener, calibrated to your specific time horizon. It means real assets, including real estate investment trusts, commodities, and inflation-linked instruments that perform when paper assets struggle. And for qualified investors, it means a measured allocation to private markets, which operate on a fundamentally different return cycle than public exchanges. The exact weights of these allocations are not universal. They are a function of your liquidity requirements, your tax jurisdiction, your time horizon, and your true risk tolerance, which is not what you report on a questionnaire, but what you actually do when your portfolio is down 20% in 90 days. The second pillar is factor-based thinking over narrative-based thinking. This is where sophisticated investors gain a genuine, durable edge. Markets in 2026 are still driven by the same persistent factors that academic research has validated across decades and across global markets. Quality companies with strong balance sheets and high return on invested capital consistently outperform over full market cycles. Value, when defined rigorously and not superficially, still generates excess returns over time. Momentum, counterintuitively, is one of the most robust factors in financial literature. Low volatility equities, particularly in late cycle environments, provide asymmetric protection. The point is not to chase each of these factors as standalone strategies. The point is to understand which factors your portfolio is currently exposed to, whether that exposure is intentional or accidental, and whether it is appropriate for the environment you are entering. Most portfolios have implicit factor bets embedded in them that the investor is entirely unaware of. A portfolio heavy in large-cap technology, for example, carries enormous implicit growth factor exposure. That can be extraordinarily rewarding in one regime and punishing in another. Know your factor exposures. Manage them deliberately. Do not let them manage you. The third pillar is liquidity architecture, and this is a discipline that separates institutional investors from nearly everyone else operating in private wealth. Your portfolio is not a single pool of capital. It is, or it should be, a tiered system of liquidity tranches, each serving a different function with a different time horizon and a different return expectation. The first tranche is your operational liquidity reserve. This is 12 to 24 months of living and operating expenses held in instruments that are immediately accessible and capital preserving. High-quality money market funds, short-duration treasuries, or equivalent instruments in your currency of primary liability. This tranche is not designed to generate returns. It is designed to ensure you never have to sell a long-term asset at an inopportune moment because of a short-term cash requirement. The second tranche is your tactical capital layer. This is intermediate liquidity, 3 to 7 years, invested in assets that can be liquidated within a reasonable time frame without significant value destruction. This is where your core public equity and bond allocations live. The third tranche is your long-duration capital. This is money you do not need for 7 years or longer, deployed into assets that compensate you for illiquidity: private equity, private credit, real assets, and venture-stage opportunities where appropriate. The illiquidity premium in private markets is real and it is significant, but it is only accessible to investors who have structured their other tranches correctly. If your liquidity architecture is broken, you cannot access the highest returning tier of the market without exposing yourself to catastrophic risk. The fourth pillar is systematic rebalancing and the elimination of emotional decision-making. This is where most portfolios fail, not in the construction phase, but in the maintenance phase. A portfolio that is constructed correctly in January will drift meaningfully by December. Assets that outperform become overweight. Assets that underperform become underweight. Without a disciplined rebalancing protocol, you will find yourself increasingly concentrated in whatever has already risen and systematically underweight in whatever has been beaten down. This is precisely the opposite of buying low and selling high. Rebalancing is mechanically simple and psychologically brutal. It requires you to sell your winners and add to your underperformers on a predetermined schedule, not based on your feelings about where markets are heading, but based on your predetermined allocation targets. Calendar rebalancing on a quarterly or semi-annual basis is one approach. Threshold rebalancing, which triggers action when any allocation drifts beyond a defined band, is another, and often more sophisticated approach. The critical point is that this process must be systematic. It must be rule-based. The moment you introduce discretion into your rebalancing process, you introduce the full spectrum of human cognitive biases: loss aversion, recency bias, confirmation bias, anchoring. These biases are not weaknesses unique to unsophisticated investors. They are hardwired into human neurology. The only protection against them is a system that executes regardless of what the narrative of the moment is telling you to do. The fifth and final pillar is tax efficiency as a return multiplier. This is perhaps the most undervalued dimension of portfolio construction among even highly educated investors. After-tax returns are the only returns that matter. A portfolio generating 12% gross returns and losing 4 percentage points to avoidable tax friction is fundamentally inferior to a portfolio generating 9% gross with a sophisticated tax management structure. Over 20 years, the compounding difference is not marginal, it is transformational. In practice, this means being deliberate about asset location. Interest-generating assets, which produce ordinary income, belong in tax-advantaged accounts wherever possible. Long-duration equity, which benefits from preferential capital gains treatment, is often better held in taxable accounts. Tax loss harvesting, when executed systematically throughout the year rather than reactively in December, can generate meaningful alpha on an after-tax basis without altering your fundamental market exposure. For high net worth individuals, direct indexing strategies now make this level of granular tax management accessible at scale in ways that were previously reserved for only the largest institutional mandates. Estate and succession planning is equally inseparable from portfolio construction at the level we are discussing. The structure through which assets are held, whether individual, trust, corporate, or partnership, has profound implications for both tax efficiency during your lifetime and the transfer of wealth across generations. Now let us bring this together with the discipline that makes all 5 pillars function as an integrated system, rather than a collection of independent decisions. You need an investment policy statement, a written, signed, reviewed, and rigorously followed document that defines your objectives, your constraints, your asset allocation targets, your rebalancing triggers, your liquidity requirements, and your benchmarks. This document is not bureaucratic formality. It is the constitution of your financial life. It is what you return to when markets are in turmoil and every instinct you have is telling you to act emotionally. It is the pre-commitment device that separates investors who compound wealth across decades from those who experience a series of expensive lessons. Technology and automation amplify every one of these pillars. Sophisticated portfolio management platforms now allow real-time monitoring of factor exposures, automatic threshold-based rebalancing triggers, tax loss harvesting algorithms that operate continuously, and consolidated performance reporting across public and private assets. These are no longer tools reserved for billion-dollar family offices. For the serious investor committed to institutional-grade discipline, they are accessible and essential. The investors who will look back at 2026 as a year that accelerated their wealth trajectory are not the ones who made the right predictions. They are the ones who built a system, followed it with conviction, and refused to be distracted by the noise that will, without exception, be deafening at precisely the moments when discipline matters most. Your portfolio should not be a reflection of your current market sentiment. It should be a reflection of your long-term objectives, structured to survive every scenario you cannot predict and thrive in the ones you can rationally anticipate. If this framework has given you a clearer lens through which to evaluate your current holdings, subscribe to this channel for institutional-grade financial analysis delivered consistently. Share this with a peer who's making portfolio decisions without this level of structural rigor, and engage in the comments with what you believe is the most significant risk factor facing serious investors in the year ahead. The conversation at this level is one worth having.